What is loan principal versus interest for teens? Imagine borrowing money from a friend to buy a new bike. You agree to pay back the exact amount you borrowed plus a little extra for their trouble. That extra is what we call interest. But what exactly is the difference between the amount you borrowed and the extra money you pay? Let's break it down. The loan principal is the original amount of money you borrow from a bank or lender. If you borrow $100 to buy a laptop, that $100 is your principal. It's the core amount you owe before any extra costs are added. Interest is the cost you pay for borrowing that money. It's like a fee for using someone else's money. Interest is usually calculated as a percentage of the principal. For example, if the interest rate is 10% per year, you would pay $10 in interest on a $100 loan over 12 months. When you make payments on a loan, your money gets split into two parts. First, some of it goes to pay the interest. The rest goes toward reducing the principal. At the beginning of a loan, most of your payment covers interest because the principal is still high. As you pay down the principal, less interest accumulates, so more of your payment reduces the actual amount owed. Knowing the difference helps you manage debt better. Paying extra money toward the principal early on means you pay less interest overall. This can save you money and help you avoid getting stuck in bad debt, where high interest costs make loans more expensive over time. For teens borrowing money for things like a car or college, understanding that the principal is what you borrowed and interest is the cost to borrow, it helps you plan your payments. If you only pay the minimum each month, you might end up paying much more in interest over the life of the loan. But if you pay extra toward the principal, you can cut down the total amount you owe and reduce your interest costs. To sum up, the principal is the original amount borrowed. Interest is the extra cost for borrowing that money, calculated as a percentage of the principal. When you make payments, the money first covers interest, then reduces the principal. Paying more toward the principal early on helps you pay less in interest overall. Understanding these facts helps you avoid bad debt by managing loans carefully and making smarter financial choices.